Unlike Technique 1 and Technique 2, with some nuances or points to do them correctly, Technique 3 is straightforward. And the main difference between Technique 3 on one side and Techniques 1 and 2 on the other side is about the availability of marginal cost. And since it is not available, the way you are going to handle it is going to be just some classic engineering economic comparisons, analysis. So as you can see here, defender marginal cost is not available. So we cannot use neither Technique 1 nor Technique 2. And so we first calculate the defender's EUAC over the given lifetime, and then we calculate the challenger's EUAC, the mean one, and compare them exactly like the cases that we had. That, for example, we wanted to compare two cases. One had 6 years useful life, the other had 12 years useful life, and we had to use EUAW because we wanted to compare them. So it is that way. You are calculating EUAC for both of them, and whichever is smaller, that would be the choice. We want to have a high-level perspective on the topic of tax now. Yes, we are done with sensitivity analysis at this point. We are done with replacement analysis, Technique 1, 2, 3, and that type of thing. So we just want to do it quickly about tax. To check some points that most likely are new to us. As I have told you several times, when you are working as a financial manager, that clear thinking, that specific, unique way of looking at things is important. Now, the reason I'm sharing this slide with you is the unique look at the topic of tax. It says, consider the government as partner in every business activity. Just look at the unique perspective it is trying to give you on the topic of tax. Have you ever looked at it in this way, that the government is a partner in the business activity that you are doing? Government shares in profits from every successful venture through income taxes. Any business activity with some specific features like risk, providing value, active decision making, or that type of thing. And remember, we don't want to go into that detailed and in-depth tax analysis of corporate finance. No, we are just gonna keep it at the level of a financial manager and some fun fact and activities to do with each other to complement whatever we have learned so far about financial management. You see a very rough classification of business expenditures. One is operating expenses that so far in our course we have been focused on this type of expenses. Many examples over there, and we were constantly talking about operating expenses. Now we want to add a perspective on another class of business expenditure, that is taxable income. That, of course, can impact the result of the analysis because it's going to add to the cost expenses, and when you are drawing the cash flow, it can make a difference in the results. So we are going to just consider some general facts in this regard, but remember, if you have a strong foundation in financial management, in capital budgeting, you will consider it just a simple add to the category of expenditures. So far, you have put, for example, the cost of oil, you had the cost of maintenance, or the other cost. Now you have another cost to add to see if a venture, to see if an investment is worth it or not. So here, in this rough classification that just try to quickly classify all the expenditures into category of operating expenses and taxable income. For operating expenses, we have labor cost, material, any direct and indirect cost, and facilities and equipment having a life of 1 year or less, because in that way we can consider them immediate cost next to the other ones that you are paying when the lifespan of that equipment is less than 1 year. But when it goes over a year, there are going to be some other nuances to consider all those things. But the point, we should pay attention now. When you see it is talking about the life, you should feel confident about these things, because you can handle life now because of your mastery over the topic of time value of money. Okay, but for taxable income, you have your gross income minus all these expenditures, operating expenditures that we talked. But here it is telling you shouldn't put the capital expenditure, and we have talked about capital before, because it is not considered an operating cost when you, for example, buy a machine for $1 million. What is the operating cost or expense of this investment? You will consider it with depreciation. That in that way they consider that. And just again, quick review on depletion. See, depreciation is for equipment, for machine, cars, buildings, or that type of thing. But depletion is for natural resources. For example, you invest in a land that you are buying it because of its mineral content, and so every year there will be depletion over there, because just imagine, for example, over there is the value of $1 million worth of minerals that over 10 years it becomes zero. So it is called depletion, and it should be considered as operating expenses. So as I promised you, we are not going to get involved to the in-depth, granular analysis of tax or that type of thing. In fact, we are not going to look at this from the perspective of an accountant. No, we are going to learn it from the perspective of a financial manager, that generally how things works and how I should incorporate these numbers that Now I have extra to the other things that is taxable, that are taxes. And in the meanwhile, we are going to also learn some new points together. For example, here, the part that you see in blue fonts, and it says that if even you are buying a machine that the life of a machine, the equipment is less than 1 year, you don't need to go here for calculating the depreciation or anything. Just consider it as a cost during that year. When you want to incorporate taxes in your analysis, you will experience what you see in front of you constantly. In the first table, the table at the top, we don't see anything about tax. It is just what we learned together before this topic, before this chapter. We have gross income. The project is 3 years. What is the gross income? $200. So $200 year 1, $200 year 2, $200 year 3. We are working on the cash flow. What else do we have? Purchase of special tooling. In year 1, we get a new equipment and we pay $60 for that. And just imagine how these things works on a cash flow. So we have income of $200 and $60 of investment. So you see, we put everything in one table. We put everything in one cash flow diagram. Okay, all other expenditures, even we don't care about the types of the expenditures, and we put them here, 140, 140, and 140. So what is the resulting cash flow? In year 1, it is 0. But remember, this 0 is because you have bought a special tooling. Now, since you have seen many examples, you know that even cash flow of negative doesn't necessarily mean a bad thing. Because maybe it is investment. When you have a negative cash flow in your investment, in fact, it says that you had your own money to invest over there. So now you have this cash flow big negative at the beginning, and in the other years, in the following years, you are going to have positive one. And also the other way, if you have a big positive cash flow, maybe it's a big loan, maybe it's a big mortgage. So this 0 just means simple summation of all the cash flows you had on year 1. And for year 2, 60 and 60. Here we have a cash flow, and now I'm sure if I give you any type of challenge on this table, you can master it. To do any sort of calculation as soon as I give you the interest rate. Now, what about the taxable income? You want to see how much tax is or that type of thing. Okay, gross income related to taxable income? Absolutely. All other expenditures? Yes, even no matter what type they are. If it is labor, material, direct cost, indirect cost, we go for that because they are operating expenses. And now, another things that we need to add is depreciation or depletion, if it is a natural resource type of depreciation, losing its value over time. So here it says that how much we are depreciated, it is considered just simple linear depreciation. Okay, you bought the machine at the value of 60, okay, in year one, and now with this you can understand that it is not very accurate regarding 0 and 1 in its presentation, but no problem, because we are now focusing on another thing. So in 3 years it loses all its value. The salvage value is 0 after 3 years. So what is the depreciation per year? 20. So you can add it also as your costs. You can add it as your expenditures. So here we have depreciation charge for year 1, 20. We have for year 2, 20. And for year 3, again 20. You may ask, what is the difference between these two tables? Just these depreciation charges. We have depreciation charges in this one that will help us to pay legally lower tax. And also here we have purchase of a new machine that we had it in our cash flow, but not in the taxable income, because it is not considered that regular type of expenditure, because it is a capital investment. And when it is a capital investment, it is different from the other types of costs, expenditures that you have regarding keeping your business running. But it loses its value over time. So you are going to put that on the statement that you have, on the cash flow calculations that you have. And that's the only difference. So please, before you proceed to the next slide, double check this page and make sure everything makes sense. Because if you can understand everything in this page, you are good, my friend. In terms of capital budgeting analysis, you have all those calculations and everything. And when it says now we want to consider also tax, everything stays the same, just the numbers would be different because of the factor of tax. And now you have the taxable income, and based on the percentages, the brackets of the income, the state, the rules, the exact amount of tax will be specified. Let's do some calculations together. Imagine the corporate income is $30,000. Calculate the tax of this corporate according to this table that you see in front of you. Use your intuition, use your common sense, use your everyday life knowledge, and try to get the right answer with confidence. Stop the video, do the calculation, and check it with me soon. Okay, the income is $30,000 and it belongs to this bracket, the first bracket. So the tax rate for this bracket is 15%. So we have 30,000 times 0.15. That would be 4,500. That's correct. Okay, the next question I have for you: what is the maximum amount of tax that a corporate in the first tax bracket may pay. Stop the video, do the calculation. Okay, the maximum amount of tax for the first tax bracket will be incurred if you reach the upper bound of the tax bracket, that is 50,000. So the maximum amount of tax that is payable in the first bracket is 50,000 times the tax rate, that would be 7,500. Now I want you to calculate the tax for the income of, let's go with $60,000. If a corporate income is $60,000, what they should pay as income tax? It doesn't belong to the first tax bracket anymore. It belongs to the second one. 50,000 to 75,000. And the tax rate now is higher. And remember, you shouldn't tax all the $60,000 at the rate of 25%, because still you must tax the 50,000 part of the income according to the first tax bracket. So you are going to do it in this way. The $50,000 still being taxed according to 15%. And the remaining $10,000 would be at the rate of 25%. Now, with all these hints, please stop the video and do the math. I'm doing the math in this way. It is $60,000, so it is $10,000 in the second tax bracket. And it should be taxed at 25%. So it would be 2,500. What is the total tax? Okay, 2,500 for that extra $10,000, and also we have this 7,500 for that 50,000. So the total amount of tax would be $10,000. And now you can understand how they calculate the average tax rate. So the average tax rate would be for this company, this one, $10,000 over $60,000. That would be 16.6%. So you see, 15%, 50,000, and 25%, 10,000. And that's the reason the average tax is closer to that 15%. And here, if I show you, you see that the formula would be this: 7,500. It is always over there because it is the tax that goes on the upper bound of the previous tax bracket, plus 25% of the amount of income that is over $50,000. And it was 10,000 in our case, and totally we came up to $10,000 tax. Let's do this activity. Assume that your income in the last year was $16.5 million. Calculate the tax the company must pay according to the table you see in front of you. Stop the video, take your time, and do your best. Good luck. Here is the details of calculation. We have $16,500,000 income, and we want to see how much is the tax we need to pay according to this table. Okay, 16 million and $500,000 covers this bracket, more than 10 million, more than 15 million, and it falls into this bracket. So the company had to pay the maximum amount of tax in each of these brackets. So these are the calculations. So 7,500, as you can see, is 50,000 times 0.15 is the tax based on this bracket. For this one, 25,000, as you can see here, times 25%. For the third one, 25,000 times 34%. For the fourth one, the lower bound is 100 and the upper bound is 335. So it would be 235,000 times 39%. The next one, as you can see here in the formula bar, 10 million minus 335,000. And these are the taxes, the maximum taxes based on each bracket. So we need to add all of them. 7,500 for the first one, 6,250 for the second one, and the summation would be this. Here is the summation of this 30,000 and 8,500, and like that we do everything until we get here. The amount of tax you are paying until this point that I'm showing you now. So the maximum amount of tax that you are supposed to do until this part is $5,150,000. Now you need also to pay the tax of the bracket that you belong to. 16,500,000 in this bracket from the lower bound, it would be $1.5 million. So it is this 1.5 million times the tax. So it is the tax for that last $1.5 million plus the previous one. So totally the company had to pay about $1,700,000. As the last example for this video, because we are gonna work on this table, there are something more we need to understand about it. But go and calculate the tax for $20 million. And when you check it, $20 million, it falls into this bracket. And it says the tax is flat rate at 35%. So it means that forget about these parts. Just go and apply 35%. So what it would be? It would be $7 million. What you may say, it is not fair, because now they are paying 75% flat rate, and so they have missed paying 15% on this range, 25% on this range, and so you may think they are at loss in terms of paying the taxes according to this model. So go and do this as an activity and calculate their tax according to this model that we discussed together. Calculate their tax, and for example, tax their first $50,000 at 15%, tax their next 25,000 at 25%, and like that come down. And make sure you consider all these better rates and see what would be the tax they are paying. Stop the video and start working on that. I'm sure you got surprised, because after you applied all those steps and better tax rates of 15% or that, again you came up with the same number, same tax of 7 million here, because it is 20 million. So 20 million minus the lower bound of this bracket, it gives us this range times 35%. That is the tax rate of this bracket, and we get this one. Okay, start thinking on this, because I think we are good for this video, and I'm gonna stop recording this video and I will explain the reason in the next video. But make sure before you check the answer in the next video, you spend enough time on that, try to figure it out. You are a financial manager, and you will face many dilemmas in figuring out how the numbers can make sense or associate them with different situations. And many times it is like solving a puzzle. So try to solve this puzzle. How come that you took two different ways to calculate the corporate tax and still you are getting the same numbers?